Hello, everyone. Welcome again to another financial analysis podcast with myself, Moeed Amin, and my colleague, Ted Wainman. Today, we are going to be looking at the first of the banking companies or institutions that we're looking at in this podcast, certainly not the first that we've analyzed. I have a feeling we're going to do a few more after you see what we have found about this company in relation to its finances and of course its share price. So stick around for that. Just before we jump onto that, quick reminder, don't forget to like, share, subscribe. We take a lot of requests from viewers and pretty much 95% of our videos are from you, the viewers. So do leave a note in there in the comment section and we'll get to it and let you know about it. If you subscribe, then you'll get the notification. So let's jump into Lloyds Banking Group. I'm not going to make too much of an introduction because we really want to dive into the finances and you get to see that. But suffice to say that they're a British financial institution. They've been around for a long, long time. And it's one of the largest financial services organizations in the country. As you can see there, with 30 million customers and 65,000 employees. Now, the banking institutions, particularly in the UK, recently have been enjoying great profit number growth, and Lloyds is the same. Just I think last quarter they doubled their profit to £2 billion. That's profit, obviously not revenue. So we're not going to look into the quarterly numbers for you. What we're going to look at are the audited annual reports, and we will analyze them to help you notice or look at what you're going to be looking at in the quarterly report. So we're going to help you analyze those future announcements and the next annual report as well. So this is going to be a really interesting video for you. We're going to really help you kind of figure out how to look at some of these banking financials. So Ted, let's jump right into it. I'm really excited to share with our viewers what we found, especially towards the end. Let's share with them about the finances.
So hello, Moeed. Good to see you again. So we are going to be looking at the annual report and accounts. It is out of date. So if you want to leave a comment that says this analysis is woefully out of date, you are more than welcome to. We already know that. But please do be polite in all your comments. And of course, do like, share and subscribe. Do share any comments, any thoughts you have about the bank. So without any further ado, we're going to jump into the financials. Here are the annual report and accounts of Lloyds Bank. And this is a hefty tome. This is available to download on their website. I would strongly recommend it if you suffer from insomnia. 360 pages you have to wade through of what they do and their strategy, and all the kind of corporate governance and pretty pictures and just tons of metrics and finance, and we've got kind of risk and corporate governance and just all the rest of it. So we're going to go all the way down to page 217, where we are going to find their income statement. So this is what we are concerned with. And all we do is just going to look at what a bank, what the financial statements of a bank actually looks like. So we spend most of our time looking at a corporate company, and I just thought it'd be quite useful to kind of look at a bank's financial statements. So here we go. Let's jump in. And the first thing we notice is they have interest income of 14. And you notice this is in millions, so that's 14,000 million, 14 billion pounds. Okay, so this is as you said, a very, very substantial financial institution here in the UK. The interest income, that's what they charge you to borrow money from them, your mortgage, your credit cards, your personal loans, your car loans, etc., etc. All of that, that's the interest income, 14.3 billion, quite a lot. Now, where do they get the money from? Well, they actually take the money in from deposits. Okay, so the people put their money in the deposit account, and then Lloyds Bank then lend that money out. And you'll notice that they have to pay you an interest, and they pay you a little bit less than they charge for the mortgages. In fact, they pay you considerably less, because you'll notice the interest expense is only 13.6 billion, leaving them with a net interest income of $10.8 billion. Now,
so just to note, not 13 billion, 3 billion.
Sorry, 3 billion. So 3 billion. So the net interest income is 10.7 billion. So the way to think about this is, if we were thinking about Coca-Cola, for example, the interest income is the equivalent to the sales. The interest expense is the equivalent to the cost of sales. And therefore, the net interest income, what we call NII, is the equivalent of their gross profit. Okay, now these guys are a commercial bank. A commercial bank is concerned with borrowing money in, taking money in from depositors and lending it out. That's what they do, and they take it in at a they pay a low rate of interest for the stuff coming in, they charge it out at a high rate of interest, and that's where they make their money. Okay, now if you look at an investment bank, investment banks have much lower amounts of net interest income. So we can see that these guys are a commercial bank by the size of those numbers. They also make some additional money. So you'll notice here they've got some net some fee commission income, fee commission expense, and then net fee commission income. So this fee commission income, this will be things like, you renew your mortgage, they charge you a fee. They charge you a fee for your credit card, for example. They charge, they do a little bit of trading. They'll charge you fees and commissions for those trading, foreign exchange, the commission, that kind of stuff. So you can see really very, very small. Goldman Sachs, for example, going to be very big in that and much smaller in the net interest income as a comparison. They making some trading income, so they are trading and they're making some trading income, which is good. That's kind of running their own book. And then you'll also notice that they are making some insurance income. So these guys, obviously, they are providing insurance, and we just want to check. We can see the claims for that insurance down here. So they're running an insurance book, but they're not doing very well at the moment. So about 8.6 billion of insurance premium income and 14 billion of claims and potential claims, what's known as IBNR, or incurred but not reported, means that they are making a loss on their insurance side of the business. Not so good there. Bit of other operating income, and that gives us the total income of $30 billion. So quite a lot of income coming into this bank. Scroll down a little bit further, we can see the rest of the income statement. Here it is. So we've got the claims, which is related to the insurance business. They're going to have some other operating expenses, and you'll notice some regulatory provisions, but other operating expenses, total operating expenses about 9.7 billion. Now, a big substantial chunk of that will be staff costs. They employ something like, I think it was about 60 to 70,000 people, and all of those people need to be paid. And some of them are, bankers are going to be paid like bankers and bonuses and all that kind of stuff. But they're going to also be paying a lot for regulatory, all the form filling they do and the regulation. They're going to pay a lot on IT. So banks, big investors in IT and in their IT systems. And you'll notice down here, we've got an impairment charge. Now, the impairment charge is effectively the reduction in the value of the loans. Okay, so what banks will do is that they'll have a loan book, and we'll see that loan book in a minute when we look at the balance sheet. They lend that money out, and if you miss a payment, they go, oh, we're not sure about that. And if you miss 2 payments, they suddenly go, we think we might not get all the money back. And so what happens is that as you miss payments, you get put onto this kind of, this increasing scale of increasing provision for bad loans. And effectively, that's what this impairment is. So this impairment is saying we don't think we're going to get certain amounts back. Now, quite interesting. That's quite a big number. Okay, now what we don't know about that number is it a big number because they've been lending to people who they shouldn't have been lending to, or is it a big number because they are taking an increasingly prudent approach, and so they've decided that they're gonna over provide. Okay, and we don't know that. That's where the auditors come in, and hopefully they're being prudent and they're being consistent, and they're not kind of going, oh, we'll just bank a loss this year so we can make a big profit next year. Okay, but that's potentially open to manipulation. And there's a little bit of information if you want to have a look at that. You can look in note 13 and you'll see the different categories of what we call non-performing loans, or NLPs. So there's the profit for the year, 1.3 billion, down from the previous year, 3 billion, down from the year before that, 4.5 billion. So you would be forgiven for thinking, you know what, I don't want to be investing in these guys because it's just going down and down and down and down. And they, maybe they have recovered from the losses of the global financial crisis 2007-8, when they swallowed up HBOS and nearly went bust themselves and had to be bailed out by the taxpayer. Or you might be sitting there thinking, actually, you know what, this is kind of the nadir, this is the bottom, and things are only going to get better from here. We're going to look at their share price a little bit later on. Before we do, let's look at their balance sheet. So here is the balance sheet, and here we're looking at the assets. Now, at a very high level, the total assets of this bank, $871 billion. Okay, $871 billion. The biggest asset by far is their loan book. Okay, so this is effectively this bit here. It's the $515 billion, and that is really made up of loans and advances to customers, a little bit of advances to other banks, and some debt securities that they've bought. But really the big number here is their loan book. So these are your credit cards, your overdrafts, your mortgages, for example, anything like that with Lloyds Bank. They've also got some cash kind of stashed away. Part of this cash is they need to be able to to basically pay out should you come into the local branch and need to get some cash. So here's the cash they've got. So they've got cash actually in the branches. Less and less important now. Think about how much cash we use. Not really. We tend to use electronic payments today. And they've also got cash at the central bank. So whereas I might bank at Lloyds banks with the Bank of England. So this is our cash at central bank. This number here is kind of investments, but they could become cash if needed. So it's like, if we're running a bit low, then we can sell those investments. So they need to be pretty liquid. It needs to be pretty easy to turn those into cash to sell them. And these will be things like marketable securities. So we just need to make sure that the money markets stay open so that we can realize those if necessary. The other big numbers are property, plant and equipment. And also they've got some assets arising from reinsurance. So this reinsurance. This is really the kind of the part of their insurance book. It says that we're going to have some claims, and if we get those claims, then we can buy on our reinsurance contract. So what an insurance company does is an insurance company insures your car, and then what it decides to do is it buys insurance itself to protect itself from sort of massive losses. For example, I don't know, you drive your car into an airport, and all the planes crash as a result, and they get a claim for £1 trillion or something stupid like that. So they'll buy reinsurance themselves. Okay, and this is basically saying if we have to pay out on our liabilities, then we can claim this is an asset. And we'll see the liability, the unpaid claims on the other side of the balance sheet. Property, plant and equipment, pretty straightforward. That's pretty obvious what it is. So, they got lots of cash. Why not? So buy your buildings rather than renting them. And those are really the big numbers. Few more assets, less liquid assets, these ones. But otherwise, that is your balance sheet. So very, very strong signal that this is a commercial bank, again, because of the size of that loan book. Okay, so if you look at the balance sheet of an investment bank, you won't see anywhere near that sort of size number for the loan book. Here's the other side, the equity and the liabilities. So the liabilities, total liabilities are $821 billion. Pounds, 821. And the biggest liability is the customer deposits. So this is the amount of money that the customers have deposited with the bank. So you can start to compare the loan book with the deposits, and you'll notice there's a little bit of a difference there. And so what they've also done is that they will have borrowed some money. So these are the debt securities in issue. So effectively, Lloyds Bank has gone into the debt capital market and borrowed money and used some of that money to lend to you for your credit card. Okay, so obviously they're going to be paying less on the interest that they borrow the money at, and they'll be lending it to you at a higher rate of interest. Here's the liabilities arising from the insurance contracts. Remember, there's a protection in there, so they do have that 20 billion of, if we have to pay out 116 billion, we can reclaim 20 billion. So the net effect is less than 100 billion. And this will be kind of a reflection of, the insurance contracts that they have been writing. So it's a fairly substantial amount. And depending on what we call the tail business, if it's long tail, they won't be paying it out for a long time. If it's short tail, then they'll be paying out reasonably quickly. Little bit of derivatives in there. we're not going to talk about derivatives, but they sit on one side of a derivative. Usually you'll find, and we'll just double check actually. So if you look at the derivatives on one side of the balance sheet, 27 billion, we should be able to find a similar number on the other side. So there we go. Derivative financial instruments, 29.6 billion. Let me just highlight that. So there's the derivatives on the other side. So typically banks are in the business of hedging. So for example, if you say you want to buy euros at a future point in time, then they'll enter into a contract on the other side that agrees to sell euros to somebody else. And that's effectively what banks are doing. So when we talk about hedging, what they're doing is they're entering into a contract, and then they're entering into a contract the other way round, if that makes sense, to make sure that they don't have any exposure sitting on the within the bank itself. And they can make a little, they can charge a fee on both sides, and they can make some money out of that. And that again comes into that fee income that we see in the income statement. Just to give you an idea, sort of size-wise, so RBS. When RBS, effectively went bust in 2008, the bank had assets of $2.4 trillion. Okay, so $2.4 trillion compared with this bank, which is at 871, and they had a trillion. Sorry, they had a trillion of derivative contracts. So a trillion on the assets and a trillion on the liabilities. So that's a kind of reflection of the banks just getting so involved in derivatives, and then of course the whole thing blew up with the credit default swaps, etc., etc. So those are the kind of the main liabilities. Nothing else really jumping out at me. So 821 billion, 871 billion of assets, 821 billion of liabilities, which means that they've got basically 40 billion of equity. So that's this 50 billion of equity. There it is, or the total equity, this number here. So there's our total equity. And effectively, this is what the bank looks at in terms of its ability to absorb losses. So they're basically saying, can they absorb losses? So if, for example, you have a credit card with Lloyds Bank, LBG, and you decide that you're not going to repay it and you scoot off and leave the country, then Lloyds Bank takes the hit, and they need to make sure they've got enough equity there, enough capital to absorb that, so that the people who have deposits at Lloyds Bank don't lose their money. Okay, very important that we don't what's called break the buck. So somebody who deposits their money at Lloyds Bank needs to know they are going to get that back. So 50 billion looks pretty good. You've got to, life's got to get pretty tough for these guys. The assets have got to go down. The liabilities have got to go up pretty significantly for that to change. To give you an idea, when they bought HBOS, that number was about 10 billion. Okay, and so 10 billion just wasn't a big enough cushion, which meant that everybody looked at Lloyds Bank and said, "You're going to go bust. You're next to go," which is where the government had to step in and basically recapitalize the entire thing. So what we look at here is that British banks, American banks as well, less so European banks, have been repairing their repairing their balance sheets. So, this loans to customer number, this is a big key number here. How strong is that number? How confident are we that, there's a lot of equity, mortgages, there's a lot of, equity behind that. There's houses behind that, on which those mortgages are secured, and that the bank feels confident that it's going to get that money back. At the end of the global financial crisis, they were shot to pieces. And I give you an example of this. Somebody who can't pay their mortgage phones up the bank, says, "I can't pay my mortgage." The bank says, "It's okay. We'll just put you onto an interest-only mortgage." Okay. And if we put it onto an interest-only mortgage, as long as you're paying the interest, we can pretend that you're still going to repay me the entire capital. And therefore, that 498 stays as 498. Okay. So this is a little bit kind of, window dressing going on, and we need to be quite careful of that. So, since the global financial crisis, the UK banks have really repaired their balance sheets, and they're much stronger there. They're in much a safer position, and you probably get letters from them on a regular basis saying you've got 85,000 covered by the government. You'd be very, very, very unlucky to lose any more than that. These guys are not going to go bust. It's just not going to happen. Okay, that could be famous last words, and I could rue the day, but quite frankly, we can survive the pandemic. These guys are not going anywhere. They are well capitalized. They've got strong balance sheets, and they are looking pretty healthy, and they are starting to return to profitability. Now, What's quite interesting about this, and you muted it, Moeed, is when we look at the share price and think about the kind of the latest set of results. And we haven't looked at the latest set of results. Here's the share price. I've put max, so it's kind of going back to 1990s, and we can see that for Lloyds Bank went all the way up and then all the way back down again, and it's it's really kind of languishing in the doldrums. So you can see very clearly the global financial crisis that was here, and the bank just completely tanking and effectively being part nationalized, and it's been bouncing around in this kind of trading. It's been going up and down and up and down, and nobody's really sure. And if you've been a shareholder, you're kind of getting a little bit, I don't want to be owning shares. Sometimes they go up, sometimes they go down. I'm not making any money from them. However, if we look and zoom in to the last year, what we can see is a much better, a much more positive trend. So there's definitely a trend going up. Okay, it's not a straight line, but it never is, but it is definitely on the way up. Now, a couple of things to notice. Market cap, this company trades at below net asset value. Remember, the equity value is 50 billion. Market cap 34 billion or 35 billion. So it's actually, you're buying a bank, you're buying it for less than it's worth on a breakup basis. Okay, this is cheap. The next thing to notice, the PE ratio, 7.5 times. 7.5 times price to earnings ratio. I mean, that's crazy. That's like 15% yield. These guys are incredibly cheap. Just to put that into perspective, Tesla was over 1,000 times PE ratio when we looked at it, okay, which was very, 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 very expensive. Now, lots of good news in Tesla, but it's all reflected in the price. Lots of bad news about banks, but less bad news now, but the price still reflects that bad news. I'm sitting there thinking, if that isn't a buy signal, if you're a contrarian investor, if you like to buy stuff that nobody else likes before they like it, you're kind of thinking it's staring you in the face. Nobody likes the UK stock market. It's trading on half the value of the US stock market. US stock market really expensive. UK stock market really cheap. I'm not saying it can't stay cheap, and I'm not saying that it can't get cheaper, and I'm not saying that the US stock market can't get more expensive and you can still make money. But if you're a long-term investor, if you're the Warren Buffett kind of, I'm in for the long term, put my hat on, stick my money in and leave it there with a dividend yield of 3% and a yield and a P ratio of 7.5 times, you're kind of thinking this is a steal. Okay, it's not your multi-bagger. It's not your kind of buy a few quid and you'll retire rich. It's not going to do an Amazon on you, but it is, I think, quite a good opportunity for a long-term play on value as the markets start to come back to liking the UK, because after it was Brexit, it kind of just killed us. We're still here, we're still trading. There's teething problems, but the UK market is undervalued. I mean, it's crazy when you look at it on a global scale. We're down with people like Turkey and Russia. I mean, come on, this is a G7 economy. We can't be that cheap. It can't be that obvious. Anyway, that's my kind of, maybe I'm getting a bit ranty there, so I have to be careful. And obviously, I'm not giving you advice. I'm just giving you my opinion. But I'm thinking, what, if this isn't in your portfolio, just as a, just there, then, well, I don't know. There you go, Moe. There's my thoughts.
I'll tell you what, I've not heard you this excited about a PE ratio or dividend yield in quite some time, I have to say. So this was a really interesting one. I hope this was an eye opener for our viewers, especially if you're going to be looking at these financial institutions going forward. The structure of what you see in the balance sheet and the profit and loss accounts are going to be different from, say, your technology companies, a lot of which we've looked at. This has hopefully helped you analyze and kind of realize what to look out for when you're analyzing those future financial numbers. So Ted, this was a great video. I'm glad we've done this, and I'm hoping we're going to do some more. Really hope that you as viewers actually give us some requests on other financial institutions that you would like us to look at. We'd really like to look at this now, given how cheap this stock looks to be. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next show.
See you later, Mary.